Here is the truth nobody tells you. Every trading strategy fails. Market structure, supply and demand, even smart money concepts and ICT. All of it fails until you add one missing piece that can turn your strategy into a profitable one. This single piece can actually turn any strategy, no matter how simple, into a real edge. That means even if I can take, for example, one of the simplest strategy, which is an engulfing candle, I can make an engulfing candle work just using this. Even people trading SNR and trend line, they can actually make more money than people trading ICT and smart money concepts just by applying this one single concept or one single piece. I've tested a lot of strategies and a lot of trial and error, and I was thinking I'm missing the secret or the holy grail of trading. But after all that time, if I had to give you one lesson that separates profitable from unprofitable traders, it is this. Nothing else even comes close. So here is what we're going to answer today. Why does your strategy still fail? So even if you see people using the same strategy, yours is failing, theirs is succeeding and they're making money, we're going to answer that. How can this make even the simplest strategy work? I give you an example of an engulfing candle. Just using an engulfing candle, we can make that work. What is the right way to apply it to any strategy? So don't worry, even if your strategy is unique, even if it's, I don't know exactly what the rules, but I'll show you how to apply this to any strategy available. So let's consider this as, for example, 15-minute time frame chart, okay? And we have highs and we have lows. Now, if we look at this from a liquidity perspective, so let's say you focus on liquidity sweeps. This is a liquidity sweep, right? There is this one. Now there is this one and there is this one. So which one do you take? There's also this one here and this one. Which one do you take? If we look at this from an order block perspective, maybe there is an order block here. It failed. There is this one here. It failed. But maybe this one worked. So which one do we focus on? Now, focusing on liquidity, I can take this one and I can take this one. This one might give me maybe, if I take this one, maybe 1-to-1. Okay, if I enter here with a stop loss here, maybe 1-to-1. But this one gave me actually much more. So from here all the way to the highest high here, this is the maximum reward to risk. This one is a huge trade. So how do I focus on this other than this one? How do I focus on trading this liquidity sweep or this one other than this one or this one? The answer is going to be in today's lecture. We're going to focus on high probability conditions and we're going to be focusing on high reward to risk conditions other than just catching these small moves for 1-to-1 or, sometime even negative reward to risk. Now, what's the issue here? What's the issue on that chart that I showed you earlier? The problem is that you are trading the noise. So you could have actually a much more clear picture of the chart. You could see the chart in a different way, more clear and focusing on high probability zones other than focusing on every opportunity and focusing on quantity. Because we're talking about quantity, what is the difference here between this and this? So to the left, what we have is more trades. To the right, we have less trades. Not only that, but here we have a trade. Even just focusing on 1-to-1, we got stopped out and then price goes up. Here, maybe we get 1-to-1, yes, but then another trade. And here you can see the difference. Here we focus on one side of price action. So here we're focusing on shorts, and here on shorts, we don't try to catch every high and low. But here, this approach is catching 1-to-1 to the lower side, then going long, and then going short, then going long. And it's the cycle of catching, actually trying to catch every high and low, because you cannot catch every high and low. Now, the difference here is here we focus on quantity and here we focus on quality. And if you've been trading for some time, you would know that the more trades you take without following your plan, it actually gives you less money. So at the end, if you focus on being a profitable trader, you need to be very picky about your trades and focus on quality other than quantity. So this is the wrong approach. This is the right approach. Adding that piece that we're going to be talking about today and on the next slide takes you from trading like this to trading like this. This video is going to take you from focusing on a lot of trades, catching every single high and low, to catching huge trades, focusing on one side of the direction, either long or short, and then holding more with a tight stop loss. That is going to be the difference. The missing key is alignment. As simple as this. Imagine just having an alignment in your trading solves a lot of the issue. In my opinion, based on the people that I mentored, most of them not looking at alignment is the reason they're still unprofitable. They just look at one time frame and looking at a specific setup such as this one. So if I focus on sweep and then breakout structure, or if I focus on, let's say, an order block or supply and demand, just focusing on that, or just an SNR zone, something like this, I want to trade off it. If you don't have alignment, probably it's not going to work. Now, alignment is using different time frames. In one approach, and we're going to be discussing the approaches, higher time frame to lower time frame. Direction is using the higher time frame. And then for the entry, we're going to be looking at the lower time frame. That is simply what alignment is. But I'm going to show you how to apply it to your strategy. And even if you understand the concepts of time frame alignment or the concepts of top-down analysis, still stay in the video, because you might actually not understand it correctly, or probably you might have the wrong view of top-down analysis, maybe based on some other teaching the wrong way of it. Now, before we continue, I've taken everything I learned over the past 7 years and put it all in one place. It's cool. This is my community. Inside, you'll find structured courses, including the exact strategy I use every day, the Edge model. These are some of the trades that I've taken with my members in Edge school using the Edge model. You are welcome to join if you want to make the real change in your trading. Now let's continue. So the wrong way of doing it, and this is where most people actually on YouTube, if you go to any top-down analysis video, they're going to go this way. They're going to tell you that, oh, you need to start from the monthly and then go to the weekly. Make sure these time frames are aligned. And then if you are executing your trade on the 15-minute, you want to see monthly, weekly, daily, 4-hour, maybe hourly. And then you want all of these to be bullish in order to take your long trade on the 15-minute. This is the most wrong thing I've ever seen. Why? Because this will not happen 99% of the time. Now go to your chart and try to align these time frames. You're going to see maybe 1% of the time they can be aligned. Also because they don't understand the difference between higher time frame and then high time frame. I mean, it all starts with edge, but one is higher, ends with ER, and one ends with an edge, high. The difference here is one is relative to something, one is not. Higher is relative to something. Now, if we take a look at 4-hour here, a lot of people would say that 4-hour is a high time frame, which could be true, but it's not higher time frame, because sometimes if we have the alignment of weekly to 4-hour, in this case, 4-hour will be your lower time frame because it is relative to the weekly. And when we compare it to the weekly, it is lower. Okay, that is the way to understand it. And we're not going to be using something called high or low. We're going to be using higher and lower because now it is relative. As I said, the right way is using higher time frame to lower time frame. That is one approach. And that is the approach that I do recommend most people, especially beginner, to go with. There is another approach which is using 3 time frames. And this is one I also explained before, higher time frame to intermediate time frame. So this is added here in between, and then lower time frame. This is already explained on one of my videos, and I'm going to be recommended to you. We're going to be discussing the first approach here, which is higher time frame to lower time frame. That means we're going to be using 2 time frames here. The alignment happens when we have this higher time frame key level. This could be anything. This could be supply and demand. This could be support and resistance. This could be a fair value or imbalance. This could be an order block, whatever, anything. So let's say that this is a key level. Key level means any of the previous things that I mentioned. Okay, higher time frame key level. When price comes to that level, when I see this bullish key level showing a reaction on the lower time frame, and now the price action on the lower time frame is showing a bullish signature, it could be whatever. Now it could be a breakout structure. If I'm looking, and this is something that you're going to decide yourself when, and what makes the alignment there, what validates the alignment. This is going to be an answer from you depending on the strategy that you're using. Whenever we have that alignment, it could be here, it could be here, based on your trading strategy, it could be here. At that moment, we're going to be looking for longs, because now we have the alignment between the higher time frame, which is going up, initially, and then the lower time frame is going up too. So now we have the alignment and we can pull the trigger and execute. These are the time frames that we're going to be using for the time frame alignment: higher time frame here and lower time frame here. So if you use your higher time frame as weekly, mostly for people who like swing trading and holding trades for days and weeks, then you're going to use your 4 hour as your low time frame, daily to 1 hour, 4 hour to 15 minutes. This is my main one here, and this is the one that we focus the most on each school and using the edge model, even though each model works on any of these time frames. And then you could also scalp based on the 15 minute and 1 minute. Other people use a different time frame alignment, which is, as an example, daily and 4 hour, and there's nothing wrong with that, but I do prefer to catch a huge part of that, higher time frame move. So when I'm using the weekly level, yes, 4 hour could be a bit more risky than the daily. However, if I catch that trade and if I get experience with it, I can go from, as an example, 3 reward to risk to maybe 7. That is the difference. It could give you double the reward to risk just following this time frame alignment. Yes, it is a bit harder, more risky, but it gives you more reward too. Now, when we talk about alignment, why is it the missing piece in your trading strategy? What does it add to your trading strategy and to your trading plan? It adds automatic direction, and that means just by having a key level and then you're trading at that key level. So let's say this is a key level and prices come in here in the low time frame. When price goes to that key level, you already have an automatic direction. When price is in a bullish higher time frame level, your direction is automatically being bullish. You have a bullish bias, so automatically it gives you a direction. You don't need that idea of, oh, I need to find the direction, I need to find the daily bias, all of these things. Following the time frame alignment is already, an automatic direction. It can also give you a higher reward to risk. If I can trade from a key level to another on the lower time frame, and I'll be taking the swing point to maybe this one. So trading from a swing point to a swing point using the low time frame, but following and focusing on the key levels on the higher time frame. This is the secret that gives you higher reward to risk. It also gives you higher win rate because now you are trading with a trend, and even if you're against the direction, so even if we have a bearish key level and you are bullish, still this key level is going to give you a reaction, and based on the lower time frame you can actually take 3-1 or 4-1 even if you are against the trend, if that key level is valid. We also focus on quality over quantity. That means we're going to be focusing on specific trades that has a potential of high reward to risk and potential of giving a huge move, instead of focusing on moves that gives you 1-1, another 1-1, another 1-1. That could also end up in a loss. So we are here focusing more on the quality other than the quantity, and this is what alignment adds. When you add these here, it makes your strategy having higher win rate, higher reward to risk, give you direction already, and then you become more picky because now you're focused on specific levels, then you execute your strategy. Now, how do we apply this? How do we add this missing point? We're going to go now to Trading View and show you everything and show you some trades that I've also taken on each school with my members using the same concept. So let's start with dollar yen here, and I want to focus on this specific price action because in my community we almost caught every possible high and low here, and we're trying to catch this one, but all these are really high reward to risk. And if we switch to the 15-minute, you're going to notice something, that instead of catching this or catching this or this one here, the short or this long, we were focused more. So if we just go blindly on the 15 minute, you're going to notice that I did not execute anything here except this, and we try to take this one, but then no enough retracement, and this one. So why not this? And why not this? And why not this? Why not go along here? This is the answer. Time frame alignment is the answer to this. So if I were just to go to the 15-minute time frame here, how can you know? And the answer is very simple. How can you trade this instead of all these minor moves? How can I catch this all the way to the low and then maybe go long here? The answer is time frame alignment. And why? Because now, so this is the price action on 15 minute. If I just switch to the 4 hour, this is going to be my higher time frame. 15 minute is going to be my lower time frame. I'm gonna ignore anything. So as price is going up here, I don't have any key level. So I'm not interested in anything. Nothing is interesting to me. But then I do have a creation of a key level. What can I do here is now switch to the 15 minute, and now you go short based on that 4 hour structure, but then trading as if you're just trading the 15 minute. A lot of people will just focus on, for example, liquidity sweep or session sweep, all of these things, or just in imbalance. But an imbalance can happen anytime, anywhere. How do I pick the one that is really significant? This is one here. What happened after is, instead of just focusing again on the structure of the 15 minute, no, I'm gonna wait for, and this trade here, this one, I all take all of these live in its call. Now, yes, I did not enter all of these, but I did call all of these even before they happen. Now, as an example, this one here, going 15 minutes. How do I know this is the right time? Because I could go short maybe here, maybe just before. How did we, focus on this one? Because now this one is a part of a 4 hour level. We enter based on this. We enter based on this. And instead of just going over 15 minutes, now we have a lot of noise. Now let's say that your strategy is just a fair value gap. You focus on fair value gaps. What you can do is first focus on what you're gonna do on the high time frame and what you're gonna do on the low time frame. You decide. So if I want to do fair value gap for everything, I just want to focus on fair value gaps. What I can do here is higher time frame and lower time frame both as a fair value gap. This is an example. You can actually look at higher time frame as fair value gap and lower time frame as a breakout structure, for example. So you want to see this thing here. Now, if we take higher time frame and lower time frame as fair value gap, how can this be? Now, an example of an imbalance trading plan, as an example, we do have this one, where is 50% of that imbalance here. It is the extreme one. When price goes to that imbalance, so let's see. So price goes there, probably, yeah, exactly there, exactly to the 50% of the imbalance. All I want to see is price coming out of that imbalance, which is probably, let's see, this one here, this wick. That's a huge wick. Probably I'm not gonna trade that one. Okay, maybe let's see another example. Now, yes, it pushed lower after that, huge move to the downside, but I want to focus on one that gives the entry, which is into the higher time frame fair value gap, creating a lower time frame fair value gap. This is one example. Now, not only that, but if you're trading, as an example, you're trading SNR levels. Now you focus on this on the higher time frame. And maybe you want to look for the same thing on the low time frame, or you just want to look for a breakout structure. Now this, when you have the alignment between, as simple as it looks, but when you have this alignment, this is a trading plan. This gives you higher reward to risk. This gives you, higher win rate, because now you have an automatic. Think about just having, going to the daily time frame and looking for a key level. As an example, this is a key level here. Now notice, even though the trend is against me, still price gave a reaction of that key level to the upside and then started going lower. And there we have an imbalance. Price respect 50%. Because we have daily, now we go to hourly. Let's see what happened. Okay, even if I'm against the trend and I will be executing based on this level. Maybe we enter, randomly anywhere, maybe in this imbalance or anything. Stop loss goes below. Even if I'm against the trend, still, I was able to get 4 to 1 reward to risk, and that is huge. Now, this 50% imbalance, or this one, okay, I think this one here is the daily. Price respected. Respect here. Again, I don't like the wicks, but maybe let's focus on this one where we have an imbalance. After that, if we were to execute based on this imbalance, that's a huge one. Instead of just catching a small move randomly from here, we will focus more on this price action leg and then a huge move to the downside. So even we are against the trend, still this level push to the upside and give you 4 reward to risk. Same thing. This is against the trend. We are going to the downside, but you notice this key level, even though we are against the trend, if we switch to the hourly, you notice from here all the way up. So depending on your entry, stop loss here, and then if we switch back to the daily, where do we have another daily key level as an example? I can see one here, maybe price reaching this level, and then you notice price given almost 5 to 1 after all of this. So this is how we blend higher time frame to lower time frame, and you can adjust this to your trading plan. As simple as this. Now, in short, without alignment, most of the strategies that you will see on YouTube or your strategy either fail or underperform. So you can either make it work or you can even make it better. Alignment here is going to equal to confidence. Thank you for watching. This is the end of the video. Make sure to check out It's Cool, my community. If you want to learn more about my trading strategy and be a part of my community, make sure to share the video with your friends, leave a like, leave a comment, and I'll see you next one.